Og jeg sier til en gjest vi har hatt før, Karen Harris, som leder makrostrategi I Bain Co fra New York, visiting Norway. Thank you so much for joining us and welcome back.
Thank you.
I said, head of macro trends in Bain Co. To meeting Norwegian executives here in a fascinating world, we must say. We've talked a couple of times before. Now Trump is here for a second term. What are these executives asking you? Is it mostly about Trump and the trade war or other big trends in the global world we live in?
I think there are probably two major trends we're hearing about. And first, thank you for speaking English. My Norwegian is non-existent, so I appreciate as a guest here that you're accommodating me. But,
it's our pleasure.
The two major trends would be, first, what's happening with global trade. And obviously the tariffs are a flashpoint for that, but it's beyond just those tariffs to where is the global trade structure navigating to now. And the second is what's happening with generative AI, but beyond that, automation, and what impact will that have? So those are really the two big trends.
Like we talked about with our previous guest in PricewaterhouseCoopers, AI and technology is forcing, prioritization of assets and people these days. But we're often told here in Norway that our exports to the U.S. aren't that big. Europe is our big market, especially if you include the U.K. But what do you tell these executives when they ask you, why does it matter what Trump does? Because our relationship with the EU and the UK is the most important. So as long as they keep buying our things and our services, we'll be just fine. Yeah. Will we be just fine, or are there shifts now going on that affects even a region like ours, if you look at the Nordics and Europe combined?
Yeah, absolutely. Well, if we think about what the global order was when we were growing up, when most of your audience was growing up, it was this ever-globalizing system where market access was fairly open. Obviously, there were exceptions, the Chinese domestic market and so forth, but largely open, patrolled by the U.S. Navy. The assumption was that goods would just move as they were. All of those assumptions are now being broken. And the U.S. is the primary instigator of what we would call a controlled demolition of the global system. And there's a real question about how does Europe, the EU, position itself in that system? Does it become a third pole? I saw this morning that with the Draghi report about, was it 11% of initiatives have been complete, 23% not started. That was just a superb roadmap to European strength building and competitiveness. And yet the rate of that happening is relatively slow in a world where the metabolic rate of China, even the U.S. today is quite high. And so it matters for Norway what happens, given the dependence on the region, the direction that travels.
I thought it was quite interesting when you were here last year. You talked about that you at Bain expect higher real interest rates in the long term now, not only because of an aging population, but because of capital being tied up in a more regionalized world that isn't as globalized and as efficient, I guess, if you want to call it that. Is that still your expectation, that we will just have to adapt, and business leaders will have to adapt to a level of rates just being higher than we were used to, not just after the pandemic, but in the past, 10, 15 years?
I think that's right. And I would add to that factor,
with maybe more inflation underneath there, yeah?
Potentially.
Yeah.
But what drove one of the biggest producers of global capital was imbalanced trade, the accumulation of assets, right? For every good that, let's take the United States as the world's largest importer, for every dollar of good that they imported, it's offset by a dollar of capital. That's just the balance of trade equation. If this administration is successful in creating more balanced trade, then that is also less global capital moving. And so that's less supply of capital in addition to the demographics and the need for energy transition, localizing supply chains and so forth. So all of that is less supply, more demand for capital, which is structurally higher rates. Now, what's interesting about what that means for inflation, though, is in a zero-bound world, in a world where it is deflationary, which is what we lived through 10 or 15 years ago, you run into what your neighbors did with negative real interest rates in Denmark, for example. In a more inflationary world, central banks can actually squash inflation to zero with higher real rates. Now we don't know what policy direction they'll take, but it does open up policy flexibility. For companies, that means prioritizing cash-on-cash returns and real returns in ways that can be very positive. It's not a negative. Having a higher cost of capital can be problematic in some ways, but beneficial in others.
But we had a period now with low rates, especially after the pandemic, where a lot of green industrial projects were launched that have since been pulled back. But we still see in not only oil and gas and renewable that companies are prioritizing projects and capital much tougher than they used to, but also in other industries, we see big Norwegian companies, scrapping projects or pushing them out in time. Is that just a new reality we have to get sort of used to, that, to get investments going, they'll have to deliver higher returns?
They'll have to deliver returns above capital or be subsidized.
Given that you expect higher real rates for the long term here?
That's right. And so we were in a world where I think, particularly in Europe, there was a sense of urgency around climate that led to a very fast run towards energy transition, and that required cheaper subsidized capital, whereas other parts of the world, the U.S. is clearly withdrawn in this administration from feeling that urgency, and China has always been a yes and market. Yes, we'll build more coal than anyone else while we create the cheapest and most efficient markets in renewables. And when the world is running at a different rate, there's a question for Europe about how quickly it can run and what it's willing to pay for that.
Let's talk about the trade war. Since we had Liberation Day, since you were here last time,
yes.
Has it played out how you sort of expected? Because I was thinking we might later this fall, given the Supreme Court in the U.S. Taking up the case of these tariffs, we could potentially maybe see a turnaround or a reversal. How is this all playing out compared to what you maybe thought back in March?
Well, we expected that this administration, I think we talked about the last time I was here, had three very clear strategic intents: balanced and what they term fair trade, the re-diversification of the U.S. manufacturing base, and heightened national security. And we say that Bain Company doesn't work for the U.S. federal government. We don't have a contract to do that. We're not policy people. We're just observing the consistency of that. But it also has a very high tolerance for chaos in implementing those policies, a much greater level of uncertainty than most of us are used to from politicians. So did we expect the volatility around tariffs? I think that was fairly predictable. I did 12 hours of tariffs on Colombia? Absolutely not. If I tried to predict that, I could be even more wrong than I usually am, so no need to go down that path. But I think this current path is, as we say, not working. Right now, tariff revenue is 18% of tax revenue collected, according to Torsten Slok at Apollo. That's a lot of revenue that's coming in.
That's a lot of money for Congress trying to add up budgets.
Yes, well, in a necessity. Is it working to create the outcomes? Well, it's not clear, but I think it's a bit... I would not want the companies that we work with, or any company, to say it's so obviously not working that clearly this U.S. administration is going to back off of these tactics. I see no reason to believe that that's the case. And so Liberation Day, which Louis Gov described as the day investors were liberated from their earthly goods, which is brilliant.
It's a nice way of putting it, yeah.
It was a mark in the sand to say the focus will be on trade imbalances and on the U.S. interests in a way that it really hadn't been so full-throatedly before.
Even though markets have rebounded quite a bit since then, but there were some dark days in April there.
It was a bad market, seemed to give one bad day.
Yeah.
Right. maybe a bad week.
How do you read the weakening of the dollar that we observe, because we've had a weakening Norwegian and Swedish krona for quite a few years, making it a lot more expensive to go on vacation in Florida than it used to be. But the dollar, this year, double-digit, weakening compared to at least our currency and the euro as well. How do you read that? Is that a fall in confidence in the U.S. market, or is there some other force at play here?
I don't know that in such a short period of time I would draw, from our perspective, looking at longer-term trends, any real abiding implications of that. I think if we think about the role of the U.S. dollar, it's threefold. There's its role in international trade, its role as a store of value and as a reserve currency, and its role as a measure. When you think about, for example, even Bitcoin, which are supposed to be free of tethers to currency, are measured in price in U.S. dollars, and that's a powerful role. We would expect that fewer U.S. dollars that less trade would be demarcated or done in U.S. dollars. That was clearly the path between Russia and China, and any country seeing what happened with SWIFT and with sanctions, that worries about being on the wrong side of that would say, how do I diversify away from this system? As a reserve currency, its role will also likely diminish from dominance, but people still hold pounds, banks still hold gold. So there's a variety of reserve currencies, and there aren't terribly many alternatives. And as a measure of value, I think we need to look to what's happening with with stable coins as an instrument for maintaining U.S. dollar as a measure, as an innovation. And so there is a lot of different directions of travel. I guess the last point I'll make is, if there may be demand for U.S. dollars may go down, but if the U.S. does succeed, if this administration succeeds in having more balanced trade, big if, then there'll also be fewer U.S. dollars in circulation. And so the supply and demand to me isn't clear. So the value that comes from that, I think, is far murkier than I feel comfortable calling at this point.
Still up for grabs.
Yes.
Karen Harris in Bain, thank you so much. Enjoy the rest of your stay in Oslo.
Thank you very much.
For å se mer, klikk deg inn på FA.no/TV, eller se oss på storskjerm når du vil ved å søke opp Finansavisen på din Apple TV.